Enable.
UTI Mutual Fund returns with the Financial Advisor Awards in partnership with CNBC TV18. In its 9th edition now, the Financial Advisor Awards is a platform that recognizes the efforts of financial advisors across the country. Having carved a niche for itself in the financial market space, the Financial Advisor Awards has gained popularity and has emerged as a unique platform that celebrates the efforts of the best wealth preservers across different sectors of the country. This year, CNBC TV18's Lata Venkatesh kicks off the 9th edition of the Financial Advisor Awards with a power-packed interaction along with the MD of UTI Asset Management Company, Leo Puri.
For the past 10 years, UTI Mutual Fund and CNBC TV18 have been bringing to you the annual Financial Advisor Awards. This year, the Financial Advisor Awards are happening in a backdrop of a lot of optimism. The markets have been extremely kind to investors, but more importantly, the Indian investor appears to have come of age, and a record, 25,000 crores coming in every month only through the systematic investment plan. So our theme for the Financial Advisor Awards this year is riding the next wave of mutual fund investments. And to tell us whether this next wave is going to be as good as the one that ended with Samvat 2073, or will it be even better, is someone who has watched both the mutual fund industry and the Indian economy for a very long time, the man at the head of UTI Mutual Fund today, Mr. Leo Puri. Mr. Puri, thank you very much for joining us.
Thank you.
Well, first up, I wanted to ask you about this SIP culture itself. Do you think it's here to stay?
Yeah, it seems to have now settled down. I think the fundamental drivers, we've all talked about financialization, reallocation from gold and real estate, which is quite a fundamental driver. Rising affordability compounded with middle-class tendency to save is another factor. And then, of course, the shock of demonetization bringing further liquidity into markets. So there have been a number of things which have coincided here, which I think have altered this. But over and above that is a much higher level of confidence, partly due to the political changes that happened 3 years ago. That the macro backdrop, the governance foundations are stronger today. So the middle class seems to have a high degree of optimism around where the reforms process is going as well. So all of this have conspired. It has helped, obviously, that returns have been good, because that reinforces this virtuous cycle. And so it's in fact about 5,000 to 6,000 crores which is coming into equities every month at this point, in the form of SIPs. But that's a very steady sort of flow, because that gives you that 60 to 70,000 crores a year, which is a very large sum of money, obviously, and supporting the markets. So far, certainly, the story has been very positive.
Is it that this large amount of money as a whole that the mutual fund industry got was inordinately due to demonetization, and therefore should we look at some of the money as one-off?
No, I think demonetization was an added driver of some of the additional liquidity that we got. But the underlying factors were the others that I mentioned. Financialization and the sense of underlying optimism around the reforms process, combined with global liquidity keeping prices steady. So these are the factors ultimately. But I don't think we can underestimate demonetization as money came first into the banking system and into CASA accounts, and from CASA accounts in search of high yield, there's no doubt that some of it has found its way into mutual funds. And this is true of small and medium enterprises, commercial enterprises, as well as households.
We had some advantages in the sense that our macros were very good. The Monetary Policy Committee has committed to keep inflation down, and that also meant fixed income is not that attractive, real estate not that attractive, and therefore money has come. If the cycle were to turn for whatever reason and gold and real estate again became expensive, do you still see Indian investor keeping the faith in mutual funds?
Yeah, actually, I'll have two nuances to what you just said. One, some of the financialization is the fact that gold and real estate as a haven for black money are less secure than they were earlier. Okay. So it's not all about relative yield. Relative yield has been the other factor, is the economic driver, because relative yields have been low and volatile in the case of gold and low in the case of real estate. So no doubt about that. And I think actually it would be a healthy thing to the extent that with asset allocation, people in a normalized real estate market, post-RERA, better organized, a clean market, do come back and start allocating to real estate. That's a good thing to happen. And I hope, and I expect it to happen. Gold is a more complex asset because of the emotional content, and people can debate how rational it is, you know, as a store of value. But gold too will somewhat come back into favor. But the laundering aspect of those asset classes will be much diminished in any case, and I think that will not return at this point in the country.
That's good to hear, actually, to believe that this trend, is sustainable. But more importantly, there are people who keep telling us, fund managers and even non-fund managers, that this is only the flow that is coming to mutual funds. The stock of Indian investments is still in real estate, and that might shift. So there is another wall or wave of money that could come. You agree with that?
That depends, on how you look at the stock of Indian real estate, actually. I don't think it's, I wouldn't draw that simple correlation. Yes, I think that's a little bit of cheerleading and optimistic thinking. A lot of the stock in real estate is obviously in land, which is put to various forms of use. A lot of it is agricultural land as well. There is a small component of speculative investments that were in the real estate sector. Unlocking those is actually going to take some time. I don't think it's going to come back in a hurry into financial markets. So I think this is more a game about flow than about stock. The other thing that is happening is that a lot of money is coming into fixed income as well, actually. We've seen very healthy gains in fixed income markets because of the rate cuts that have happened hitherto. People have made healthy yields and double-digit yields out of fixed income investments. So we should never underestimate the importance in the mutual fund industry of the role fixed income has been playing in addition to equity. Even today you can get, let's say, 8.5% from good quality corporate bond funds, which is maybe 1.5% or 2% above fixed deposit yields. And that's a pretty healthy return. Around the world, people are having to think of what normalized returns might be in a world of lower inflation. And if you believe inflation is going to be plus minus 4% in India, then really, yields of 8% from fixed income are very, very attractive.
Absolutely.
And we must learn to look at it that way and not, shy away from that.
No, fair point. Let me come to how the mutual fund industry or the financial advisor community has been able to use these good times. Has it been taken away, absorbed by this money coming in, or have they been able to use this time to get into rural markets?
Well, I think this has been a positive time, and I think the intermediary community, the advisor community, has conducted itself in a fairly exemplary fashion. It's notable to me that there have been, at least I haven't observed, any instances of chronic mis-selling of the kind that we had in the previous cycle, if you go back 7-8 years. And I think that's to their credit, that essentially what you've seen at this point is a asset allocation strategy. People have moved into SIPs a lot. They've looked at balanced funds to a large extent. And post that initial slew of closed-ended funds, by and large, we've not had too much obvious evidence of purely commission-based sales. Not to say that things are absolutely perfect at this point, but in a realistic world where you are always going to have some combination of financial incentives and investor interest sort of finding a happy equilibrium, I think the bias towards keeping investor interest in mind has been higher this part of the cycle, and we're happy to observe that. There are one or two anomalies that continue, and I think at a personal level I have had an issue with this, maybe as a relative newcomer to the industry. We still have a tendency to offer what we call dividends in this industry. And if I were to highlight just one area where I do think there's a risk of mis-selling, it's the tendency to declare so-called dividends on equity funds, which are not really dividends at all. They're merely a return of capital, which could be just as well served through a systematic withdrawal plan, but perhaps lead some less sophisticated investors into believing that they're getting
something more.
When they're not. They're just getting their own capital back because the fund has a surplus and ability to pay this. And I think this is something which I think the regulator should firmly now stamp out and discourage, because as long as it's legally possible to do so, we will all do so, because it helps position products and investors like it. But it carries the seeds of long-term misunderstanding and mis-selling, and should be stamped out.
This is a great point to take a break and come back with the same theme. The regulator has issued a slew of directives to what it calls consolidate funds. How will that impact the mutual fund industry? That view from you. In a minute, we are back with lots more questions to Mr. Leo Puri. Welcome back to this special chat with Mr. Leo Puri, the CEO and MD of UTI Mutual Fund. Mr. Puri, we were discussing about the regulators' current set of rules asking mutual funds to consolidate. Now, these come with some rules as to how many companies should be there in one specific fund, in mid-cap, in large-cap. Your thoughts generally on these rules?
Generally, I think this has been well signaled, and on the whole, it is an investor protection move. The background is that investors were getting increasingly confused by variously labeled funds, some of whom were arguably not true to label and carried fairly exciting names around them, but the mandate may not have been clear to investors. Or you may have had funds with similar names, but which were doing very different things, and again, the investor may not have been clear what they were buying. So this is an attempt to clarify the labeling and the mandate, so that when an investor comes to our industry, buys a fund, he will know with reasonable levels of specificity what he's buying. So to that extent, it's welcome. And I think we, by and large, have looked at this, as have all houses, very carefully. And we think we'll be able to comply quite efficiently. There's only one area there where we do have an issue, which we will discuss with other industry members, which is the definition of mid-cap has been made in a very constrained way. It simply says all companies 100 to 250, and it doesn't talk about free float and so on. So this is an area where we think there could be market dislocation and, frankly, an outcome which is not in the investor's interest if we are not a little more careful about this.
So you're talking to the
And
regulator.
I think our hope is that this is an area where we can engage and find a better, more market-aligned definition of mid-cap, which will allow us to serve our investors better.
Okay. Well, it's just that in the interregnum, as funds move around their stocks, is it possible that it will have a market impact? You may be forced to sell because a new IPO has come and you have to fit it into the mid-cap. I mean, or whatever, for whatever reason, can there be market dislocations?
Yes, I think that the mid-cap category is the one we would be worried, which is why we think there may be some room for discussion around a better definition, a more market-aligned definition. But for the rest of it, I think given the time that there is a little bit of realignment, most people will find that the actual amount of portfolio reconstruction outside of this area is actually quite limited. There will be very little impact on investors or on the market for that matter. But one of the things which is going to impact the market, the stock of funds, is of course a very positive environment for IPOs. Yes. And I do anticipate some of the future flows may get traded off, if you like, with investors looking at primary markets and not just secondary markets. But that's a good thing, again, in the long term, because it's adding depth and diversity. So very happy to see, new counters like insurance open up in the markets as well.
The other theme I was asking you, has the market expanded? Have mutual funds been able to really pierce the B15s and, tier 3, tier 4, tier 5 cities?
Yes, the B15 growth rates have now consistently for the last 2 years been faster than T15 and certainly T5, and so more and more of the incremental relative growth rates you're seeing growth being spurred from outside of the T5. And again, a lot of this is coming in through SIPs and a lot of this through balance funds. So that mis-selling problem doesn't seem to be at the top of mind as this happens. I think with the rise of and self-confidence of financial advisors in some of the not just tier 1 or tier 2 but even tier 3 towns now has been very helpful in that regard.
Any percentages or numbers, or it's more
I think
anecdotal trend?
It's a statistically borne out trend. I think the incremental growth rate is probably about twice as fast at this point in B15, but obviously of a much lower base. And certainly, as a retail-oriented fund house ourselves, we do see this quite clearly. The banks have also been playing a very important role in terms of helping this happen, in addition to the advisors, because they too have very large networks and have been using those quite effectively. So this is a great welcome trend. And another area where we see a big opportunity is through the National Pension Scheme and retirement products, which as an asset management company, of course, we also offer, and which we are encouraging our advisors to make available when they actually have advice-based discussions, because retirement is a critical theme. And we find retirement is a very good hook for engaging people in some of these areas.
And people are moving?
And people
see retirees moving?
It's a very strong motivation to get people to think about longer-term savings. Then whether they come in through conventional mutual fund products or through tailored retirement products or through the NPS is something the financial advisor can actually work with them on and advise them as they think fit.
Lately, as we have seen, even savings interest rate has been cut. And of course, fixed deposit rates have been falling. You normally think of the mutual fund investor as someone savvier, who knows the product. Has the mutual fund industry and the financial advisor community been able to pierce beyond that?
To some extent, but there's still a very long way to go in that regard. I think the positives have been the trend towards simplification of KYC norms and the operational obstacles. So with Aadhaar-linked KYC, it should become much easier. With common KYC, where we will hopefully be able to ride on CERSAI and existing bank KYCs, although that's still to be closed out. It would be very simple for us if we could simply rely on the fact that somebody had already been through a KYC process with their banks. They can share it with us and we can immediately. There's a little bit of a wrinkle to be ironed out there, which I hope we don't have time to go into, but I hope will be the last mile to be unblocked there. And I think beyond that, we have made a lot of efforts, as AMFI has made a lot of efforts in communicating mutual fund sahi hai, and trying to get the message across that we are not as complex as one might fear. It's still a concern that people have to come into the right products linked to their risk profile. You don't want the widows who are in their fixed deposits to suddenly jump up and buy a mid-cap fund. And that risk must be taken seriously. You would want them to come in ideally, preferably into some mix of fixed income, actually ideally get that 1.5–2% yield on a steady basis, experience what that is. If they indeed have the capacity to take more risk, then they can actually look at equity and so on. But if it's graduated in that way, I think we'll be, we have a very long way to go yet, and we barely scratched the surface.
Well, yes, those will be the issues which the Financial Advisor Awards and the run-up to it will take forward. Well, you've given advice to the government. Let's see how things pan out. Thank you very much for joining us in this conversation.
Thank you, Lata.
Focus. Ideate. Innovate. Enable.